What's another really important thing the Fed does?
Personally, I think supervising and regulating all those thousands of financial institutions is pretty important.
You're right, but why?
I'd say because banks handle so much money and are so important to the whole economy, you can see why they need to be supervised and regulated.
We supervise and regulate the banks in our region to make sure that they are safe and sound. Because an ordinary citizen wants to make sure that when they put their money in the bank, it's safe.
The Fed, in partnership with other federal and state agencies, supervises and regulates thousands of financial institutions. Some of these are bank holding companies, which are corporations that control banks, savings and loan holding companies, state chartered banks that are members of the Federal Reserve System, foreign branches of member banks, and the U.S. operations of foreign banks. Banks weren't always supervised and regulated the way they are today. In the early years of our country, there was very little supervision or regulation of banks at all, and most of that was by individual states, not the federal government. Most regulation was simply to make sure that banks had enough gold and silver in their vaults to back up their paper currency. But financial crises and panics took their toll. In 1893, a severe depression rattled the economy and eroded people's faith in banking. Then, in 1907, a panic caused a number of banks to fail. Scary events like these helped bring about the passage of the Federal Reserve Act of 1913. One of the key purposes of this act was to establish a more effective supervision of banking in the United States.
Well, the goal of supervision and regulation is fundamentally safety and soundness. This country before the Fed faced banking panics where people would lose confidence in their bank, run to get their money out very quickly. We called them bank runs or banking panics. And of course, the banking panic of 1907, which was kind of the final straw that prompted the creation of the Fed.
Banking today is a lot more complex than it was in 1913. So bank supervision by the Federal Reserve has become even more necessary for keeping our economy stable.
We're very focused on ensuring that we write rules to force financial institutions to operate in a safe and sound manner. And we also are involved in supervising institutions, both large and small, to make sure that they're operating safely and in accordance with those regulations.
We recognize that banking is a risk business, but it is so very important from a supervisory standpoint to make sure that those risks are easily measured, those risks are monitored, and that limitations are in place.
That when they take risk, that they have taken measures to mitigate it, that they're prepared if something goes wrong.
At times, like during the Great Depression that began in 1929, Congress has tightened regulations that affect banking. For example, the Banking Act of 1933, also known as the Glass-Steagall Act, allowed the Federal Reserve to regulate interest rates in savings accounts. In recent decades, some of the same regulations were loosened by Congress, like reversing the prohibition on banks having branches in other states. Then in 2010, Congress enacted the Dodd-Frank Act. That law significantly changed the Fed's role in supervision and regulation of financial institutions. It expanded the Fed's supervisory and regulatory responsibilities to include savings and loan holding companies, certain non-bank financial firms, and payment, clearing, and settlement utilities. These institutions were seen as important to the stability of the whole financial system. Dodd-Frank also moved most of the Federal Reserve's responsibility for consumer protection to a newly formed Consumer Financial Protection Bureau.
Too much regulation can stifle banks and inhibit lending, and can negatively affect the economic activity that comes from the availability of credit. Too little regulation, on the other hand, can lead to excessive risk-taking, and then banks can get into financial difficulties, which then can cause financial instability.
Ever since it was founded in 1913, one of the Federal Reserve's main roles has been supervising and regulating banks and other financial institutions.
Over the years, that role has changed in response to some important events. The biggest financial event of the last century was the Great Depression. Many people lost their life savings because their banks' risky investments wiped out their accounts. So Congress passed the Banking Act of 1933, also known as the Glass-Steagall Act, which enabled the Fed to supervise and regulate many financial institutions more closely.
The bank has been obviously showing some signs of commercial real estate.
Supervision and regulation is still evolving today. The financial crisis that began in 2007 led to the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. The name captures the purpose of the law.
What this legislation does is greatly strengthen the provisions to require regulators not just to look at their individual fiefdom, but to look at the whole financial system and try to identify risks that might be arising as the economy changes and the financial system changes.
Those objectives are to promote the financial stability of the United States by improving accountability and transparency in the financial system, to end too big to fail, to protect the American taxpayer by ending bailouts, and to protect consumers from abusive financial services practices.
The Fed is not the only federal or state agency to watch over financial institutions. Among others, the Federal Deposit Insurance Corporation and the Office of the Comptroller of the Currency also supervise some financial institutions to ensure their safety and soundness. The Fed has responsibility to make banking safe and sound and to protect consumers, but it doesn't actually write banking laws. That's up to Congress.
Supervision and regulation takes a number of forms. The first step is that when Congress passes a law that affects financial institutions, the Federal Reserve and other agencies are then tasked with developing rules to implement that law. So one of the key things that we do, and one of our key activities, is to actually write rules.
When the Federal Reserve has written new regulations and has informed banks about them, the banks need to comply.
When the Federal Reserve examines a bank or other financial institution, it investigates a lot of areas of its operation. The Fed wants to know about safety and soundness. How secure are customers' deposits, and how well run is the bank as a business? To find out, examiners analyze the quality of the bank's assets, like loans and investments. They look at how much capital it has, and other factors such as the experience of the bank's management.
In our bank regulation area, we're very concerned about making sure that we're protecting the privacy of the institutions that we're reviewing, that we're doing thorough reviews, that we understand the macro issues that are happening in the banking industry.
Fed examiners also check to see how the banks comply with the Community Reinvestment Act of 1977.
Well, thanks for taking the time out today to show us a little bit about this community.
A bank needs to meet the credit needs of its entire community, including low and moderate income people and neighborhoods, consistent with the safe and sound operation of the bank.
In addition to on-site examinations, the Fed also conducts off-site monitoring. It uses automated screening systems to check for poor or deteriorating financial profiles.
If an examination reveals problems, the Federal Reserve has enforcement powers. Typically, the Fed informs the management and directors of the issues and sets out a plan for improvements and corrective actions. But if necessary, it can take additional, stricter steps to make sure the troubled banking organization quickly addresses its problems.
One of the important things we learned in the 2007-2008 financial crisis was how interconnected our financial institutions have become and how impact on one entity can spread across the entire financial system and into the broader economy.
We will be paying a great deal of attention to what's known as the business model of financial institutions. That is, how do they make money? How much risk do they take as they make money? How sustainable are the profits?
Ensuring financial stability is important to ensure the vitality of the economy for the long term. And the Federal Reserve, through our activities of looking across markets, looking at the banking system, and understanding how financial institutions make credit available, will help us to ensure that stability going forward.